for the ICMA for giving me the opportunity to conduct this session on ISO 31000. And a very warm welcome to everyone joining us today from different parts of the world. First of all, thank you for taking the time to be here for your interest in ISO 31000 risk management. It is a wonderful to see such a strong level of participations, and I am really looking forward to spending this session with you. As Shweb Sab has already explained about my qualifications, basically my professional background is in internal audit, risk management, and governance. And over the years, I have had the opportunity to work with risk management frameworks and their practical implementation. Today, I'll be sharing some of those practical perspectives with you, and I'll be taking you through an orientation of ISO 31000 risk management. Before we begin, I would like to set one expectation. This is not intending to be a highly technical or theoretical session. My objective is to give you a practical understanding of ISO 31000, what it is, why it matters, how its principles and framework work, and how we can apply risk management in real organizational situations. I would also encourage you all to participate. If you have questions or practical experiences, please share them through the chat or the question and answer, and we'll try to make this an interactive session as interactive as possible. Before we move on, I'd like to ask everyone a quick question. How many of you are currently working with a formal risk management function in your organization? You can simply type yes or no in the chat. And without taking any more time, you may type yes or no. And without taking any more time, let's begin by answering a very simple question. What exactly do we mean when we talk about risk? Before we begin, the agenda of webinar has already been shared with you. So let's move forward with the basic understanding of the risk management, and key concepts. And first of all, we will try to understand what is risk. Basically, risk is an effect of uncertainty on objectives. For the organizations or department or persons, first of all, set the objectives. Objectives is an activity which is undertaken by the organization to achieve some goals, which have some purpose and objective. And if that objectives have some amount of uncertainty, like lack of information or concerns regarding whether that event will be applied or not, or what will be the consequences or likelihood, and the effect of that uncertainty and deviation of the expected outcome is basically these all combines the risk. So basically, when we talk about risk, it is the effect of uncertainty on objectives. And uh, we all talk about risk and perceive it in a negative way, but the risk is negative or positive as well. So first, you have to understand the concept of risk. It is always a future uncertainty. It will be a future event. If an incident has been occurred, that is not a risk. Risk is always a positive or negative event which have an uncertainty on the future events. So let's move forward. Uh, we have discussed that there are risk regarding positive or negative aspects. When we talk about negative, it's a risk, and when we talk about its positive aspects, then it is an opportunity. Opportunity arise from mitigation of risk, or sometimes are not able to mitigate that risk. So that opportunity in that risk arises, which is positive for the organization, and it is always there to expand, innovate, and improve. Uh, 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 like a person is studying and he is unable to pass this course, and he change his field. So we have example of Bill Gates. He was dropout, and he expanded, and Microsoft is an invention. So uh, an opportunity arises from the risk. So there are positive and negative aspects as well. These are some common life examples regarding risk and opportunity. So in our daily life, we have an objective to drive to the work. There is a risk that there are traffic rules applicable, so we will be reach late, or there is a opportunity that we take a new route and save time and reach. Uh, we are planning for a picnic. There is a risk that rain spoils the event, and but there is an opportunity that is the weather is pleasant, and once we reach, we will enjoy our picnic. So again, little bit of studying for the exams. A risk is poor preparation may result in low grades, but there is an opportunity that effective preparation leads to top performance. So you can see, if there is a risk, we cannot ignore the objective and say that we will not achieve our objective. We have to mitigate the risk and achieve our objectives. So everything has a risk, built-in risk in it. The risk of life is death. So that doesn't mean we have don't do anything in our life, but we try to mitigate the concerns, the issues we face in our daily life and improve our life. So there is an opportunity that we can improve our life. So risk is there is a risk of death in life. So we can't ignore that risk. So that means there is always a risk, whatever we do in our life, in our processes, in our organizations. Uh, this is another example to understand between risk and opportunities. Let's suppose there is a new technology and company is concerned about failure of implementation and causing of business disruption if they try to launch new technology and already they are doing manual work, so their business will be interrupted. But there is an opportunity that automation will improve efficiency and reduce costs in their processes. And there is a event that there will be a new government regulations, and there is a risk that if we don't comply with that regulations, it will lead to penalties. But there is an opportunity that if we adopt that compliances, it will increase our reputation and customer trust as well. These are few examples, and hopefully these are will be available. Our session will be available on the YouTube and LinkedIn, and you guys may take screenshots of anything we are displaying here. So one more example, there is a event of cyber attack on the company, and the system will be breached and causing financial and reputational loss to the company. But there is a opportunity for the company if the company invest on its IT and IT infrastructure, it will strengthen the customer confidence as well. Now we will move to a basic concept of event, impact, and likelihood. So an event is an occurrence or change of particular set of circumstances. For example, a flood, an accident, an economic event, fraud, theft, these all events. Then we have a likelihood. Likelihood is the chance of something happening. In risk management, the likelihood has a broad interpretation, as we can see in statistical analysis, the term probability. So it's likewise the likelihood is related to probability or chances of something to be happen. Then we have a impact or consequences, an event which can lead to a range of consequences, like uh, there is an economic event which lead to financial losses to the company. So consequence is financial loss to the company, and there may be multiple uh, causes or consequences for a single event. Maybe there is a accident, but the consequences may be a minor injury or a death. So we have to manage each and every consequences as per the event and its impact on the organization or the processes. So the mitigation strategies will be adopted as per the consequences and causes of that event. Now, another concept is controls. When we talk about controls, there are multiple kind of controls which are applicable within the company. Some are physical controls, human resource controls. We will train the human resources. There are documents, SOPs, or procedures. These all type of controls are help to reduce the exposure to the risk and help to mitigate the risk. If there is no control, then we will say that there is an inherent risk. So inherent risk is a gross risk before applying controls or mitigation strategies. And once the controls have been applied, uh, the remaining risk is called the residual risk. Now, this is when we multiply likelihood and consequences, we will reach to a level of risk, and you have to choose the ISO 31000 is open or applicable whether you make the score 3 by 3, 5 by 5. It's up to the organizations. So most of the organizations are dividing it into 5 levels. Like 5 is the extreme. When you multiply by likelihood consequences, the 5 into 5 is extreme. Or the criteria can be set by the organizations, and ISO 31000 is open and can be applied as per the requirement of the organizations, and they can customize as per their need. So this is the when we talk about the level, this is the level when you multiply by likelihood and consequences. And another concept is heat risk map. It is a visual representation of the identified risk where you visually provide an bird eye view of how many risks are there in uh, low category, medium, high, or extreme category. This is a type of visual representation. Now, another concept is risk appetite, risk tolerance, and risk capacity. Risk appetite is an amount and type of risk that an organization is willing to pursue or retain. When we talk about appetite, you can see when we eat something and we say that we have appetite to eat that thing, that means we can uh, eat up to that limit, or we are willing to eat that thing, and that is our appetite. So in organization, when we talk about organizations and when we talk about risk, so risk appetite is the amount of risk that an organization is willing to pursue or retain within the processes or their organization. We all have already discussed that we cannot eliminate or reduce the risk to zero, so there will always the risk will always be remain there. So the organization and the top management, basically the board of directors and senior management, have to decide their risk appetite, risk tolerant, and risk capacity levels. So once we have set the risk appetite, we have to set the risk tolerance level. It's the acceptable degree or variability and deviation from the expected level of risk that an organization is prepared to withstand in order to achieve its objectives. All these things will lead to achievement of the objective. So when you achieve some objectives, there you will have to face certain risks, and you have to set the tone and the threshold, a tolerance level, or appetite to achievement of that risk. And with regard to this concept, there is a maximum amount of risk that an organization is willing to accept, and that is the risk capacity. This is an example. Uh, the organization has to prepare their risk appetite statements. You have already in most organizations have seen that uh, they say that there is zero tolerance towards death or injury of their workforce. So they set their risk appetite and tolerance level within their a framework, processes, and achievement of their objectives. So this is an example. You can say the risk appetite. ABC Manufacturing has a moderate risk appetite for customer credit risk. The company is willing to extend credit to growth, support sales growth, provided that potential losses remain within approved limit and effective credit controls are maintained. So this is the appetite statement. And the organization, mostly uh, uh, top management and board of directors, set these tolerance, appetite, and risk capacity levels. Likewise, they said that days sales outstanding will be up to 6 days, and risk tolerance will be up to 70 days. And then, yes, bad debt ratio should not exceed 1% of annual sales. And bad debt ratio shall be up to 1.5% is a risk tolerance. And these are the uh, depend on the organization, the size of organization, and the size of their processes and the environment they operate. So this is set by the top management.
Devasab, I think we should engage the participants to a poll now.
Yeah, yeah. Okay. I'm looking for it. Okay, I'm launching this poll.
Participants are requested to answer this poll, which is visible on their screens. All the remaining participants are requested to answer this poll so that we may move further. Javasab, I think we should now end this poll.
Okay.
And I think we need to brief the concept because some of the answer is incorrect.
Okay, most of the answers are correct, but uh, various others have more correctly answered. Okay, the question was about the inherent risk. So we can see uh, these are the risks, and this is the filter of controls, and this is the residual risk. So when we apply controls, the remaining risk that remains is the residual risk. And the risk that is before applying the controls is the inherent risk. So the question was about inherent risk. So once again, you have to clear this concept that inherent risk is the risk before applying any controls or mitigation strategies. In organizations, there are internal audit department or risk owners department. They have prepared their SOPs, procedures, and their manual. So all these procedures and SOPs are the controls or mitigation strategies. So if that mitigation strategies have been applied on the risk, then the remaining risk is the residual risk. And before that controls, if there is a risk, that is an inherent risk. So let's move forward. Another key concept is key risk indicators and key performance indicators. Most of the organizations have their set of performance indicators which they use to monitor and measure the operational strategies and map their gaps from the targets. So before the start of year, they set the key performance indicators to measure and monitor their operations. So when we talk about risk indicators, key risk indicators, they give early warning signs to the company, to the risk owner. So what will lead or trigger the risk? So the key risk indicators and KPIs are again set by the senior management and the board of directors for the department, for the organization. So these are the key concepts you have to uh, uh, take into consideration when preparing the risk management framework. So we are talking about risk owner. What is risk owner? Risk owner basically a person or entity, a department which is accountable and an authority to manage a risk. This is the definition of ISO, and COSO ERM framework says that the risk owner, the person or entity responsible for the recognizing and monitoring the status of a specific risk is the risk owner. So when we talk about risk owner, it is always the first line uh, in a IIA model of three lines. The first line is the risk owner or any other person with the responsibility or accountability to manage that risk. It will not be a risk management department or internal audit department. The first line of defense, which is now three lines defense. Defense has been eliminated. It's three lines model. So first line, the honor department are the uh, have the accountability to manage those risks. This is a concept of risk owner. So we have discussed about the risk and key concepts. And when we talk about the management of risk is always interrelated with the management. So management involves with the risk management department, and in the risk management framework, they all coordinate to apply the risk management concepts and risk management framework to mitigate those risks. So management involves in a coordinated activities to direct and control the organization, and risk management is an integral part of management, which is involved with the management to implementation of risk mitigation strategies and remove the effect of uncertainty within those objectives. So next concept is risk governance. It's a very unique and common concept these days because of promulgation of various laws applicable in Pakistan and also IFRS S1 and S2. This concept has been gaining very uh, common fame nowadays. So when we talk about risk governance, it's a combination of all the board of directors, senior management, and the dedicated committees of the board of directors, which includes risk management committee and internal audit committee and the sustainability committee of the organizations. So in the modern organizations, these all committees the risk management committee's function may be performed by the internal audit committee of the board of director as well. And but there is a also after promulgation and implementation of IFRS S1, S2, there is a sustainability committee of the board of directors as well. And these all committees, along with the board and management, will be effective in implementation of risk management framework and play their roles in risk governance. So when we talk about enterprise risk management, uh, we basically are talking about the board of directors, the management, senior personnel, risk management department, internal audit department, and the risk owner departments, which play their part in implementation of risk management framework, processes, and principles, and setting the risk appetite and internal audit department giving the assurance that the ERM framework uh, uh, is effective. So all these uh, play an integral part and form the enterprise risk management framework. Now we have talked about the basic concepts regarding risk mitigation, and uh, uh, risk governance. Now we'll talk about objective and importance of risk management, governance, and what is the importance of it and what are the objectives. Basically, the objective of risk management is the creation and protection of value. It improves performance, encourages innovation, and supports the achievement of corporate objectives. Management of risk is a iterative or a continuous process, and it assists organizations in getting strategy, achieving objectives, and making informed decisions. So we have seen that these provide insight about the future events, what may go wrong. So by implementation of risk management framework, it makes the organization to make informed decisions. And it is also the part of governance and leadership, and it is fundamental for the organization at all levels of their leadership, whether it is board level, management, or internal audit department, risk management department, or risk owner department. And it is an approach which is used by the people who create and protect value in the organization by managing risk, making decisions, setting and achieving objectives, and improving performance of the organization. So these are the element of successful risk management. First of all, we have to understand what are the emerging risks, what are the events of these emerging events, which may lead to uncertainty and uh, uncertainty in the objectives. Then the risk appetite, risk tolerance has been defined by the board of directors and senior management. And we have, after identification of risk, we have to assess all the risk and perform sound judgment through mitigation. And last but not the least, we have to foster a culture of risk management in the organization. This should be achieved through trainings, through seminars or webinars. The organization has to implement risk culture within the organization, which is very important because everyone have to integrate and work together for the effective and successful implementation of the risk management framework within the organization. These are few examples of non-commitment of the non-implementation of risk. We already know the Dieselgate of scandal of Volkswagen. Uh, uh, they were trying to reduce the failure rate of their cars emissions by cheating, by implementing uh, defeated devices to falsify nitrogen oxide in their cars. And they knew that their cars' emissions had high levels of nitrogen oxide. And instead of correcting the issue, they tried to avoid it, which led to production failure, reputational failure, and financial failure for the organization. And ultimately, 11 million cars were affected worldwide, and 8 million vehicles were recalled in the Europe. The potential fine for the Volkswagen was 70 billion plus pounds, and direct costs which were involved in those activities were 4.8 billion pounds. So this is the price when they saw that uh, a non-compliance to you can say that was a compliance risk, and they were not mitigating with, the risk. Ultimately, that paid the price. And once that incident has been occurred, that not remain a risk, that become an incident. So once you have see that there may be an emerging risk of potential non-compliances or regulatory non-compliances, these are the risks, and you have to mitigate and implement the controls from the day it has been arisen. Another example, everyone knows that there were big five uh, before that event where Enron scandal was arose, and later it affected Enron and Arthur Anderson, which were the big five global accounting firm, and they were basically that event shows that there was a systematic risk management and corporate failure governance by the board of directors. And board of directors and senior management were more concerned about their profits, and their CFO and their auditor were involved in complex accounting and off balance sheet uh, entities and loopholes to hide billions in debt, which ultimately led to the uh, uh, collapse of the Enron and Arthur Anderson. So when we are talking about importance of risk management and risk governance, we should never forget the IIA's three-line model. This is the overview of IIA's three-line model, which says that there is a first line role which consists of departments which are involved in provision of products and services directly to the clients and their customers. These are the operational departments, and they are reporting to the management. And second line roles are the risk management department, quality assurance department, compliance department. These are providing second line controls on the to monitor the risk and achievement of objectives. These two lines, the risk management department and compliance department, quality, and first line, which are the risk owner department, they are directly reporting to the management. These are the management functions in achievement of objectives and implementation of controls. Then there is a third line, which is internal audit department or internal uh, any person or third party which are providing internal audit services to the organization. These are the third line of defense, which are providing independent and objective assurance and to the management to achieve their objectives. And you can see that they are directly reporting to the governing body, which is board of directors or audit committee. They are directly providing independent assurance reports on the effective implementation of risk management framework and controls, whereas the risk management department and first line operation departments are implementing the controls. Before this model, there was a three-line defense model, which after three lines model, the line between first line and second line roles have been blurred. So risk management department can take the role of first line and implement those mitigations or control measures within the processes or controls. So this is a picture depicting the collaboration between internal audit department and risk management function, which is second line and third line of defense. So risk management is involved in proactive identification of risk management, implementing risk management, assessment of risk management, which has been identified. The risk has been identified, has been assessed, monitored, and mitigated, and they are facilitating the first line of in the our previous we have seen IIA guidelines. So internal audit department is providing assurance report on effective implementation of these risk mitigation activities and uh, framework within the organizations. So these are collaboration of risk management and internal audit department to achieve the same objective for the organization and to help the first line operations of the departments. Okay, we were discussing before the
Yavasav, I think we
IFRS.
should engage the participant once again, and
Okay.
then we should move to the sustainability S1 and S2. Dear participants, we are launching another poll which need your kind attention. Remaining participants are requested to answer so that we can move further. The correct answer is all of the above. The enterprise risk management involves all the relevant stakeholders.
Yes, that's right. Because when we talk about enterprise, enterprise is a bigger level which involves all the stakeholders, whether it's board of directors, management, employees, everyone is involved in the enterprise level.
Javasar, please proceed further.
Okay, thank you.
Right now, S1 and S2 is a crucial as all the accounting bodies are encouraging the early adoption of the IFRS S1 and the S2.
We were discussing about the importance of risk governance and risk management. So when we are discussing about the importance of risk management, then arises a question of IFRS S1 and IFRS S2 implementation. It's a key concept of ESG within the worldwide now. The IFRS S1, S2 are now mandatory to implement within the organization. So when we discuss and study about S1 and S2, it talks about sustainability related financial disclosures and climate related disclosures. The IFRS S1 is a journal requirement and have say that the company have to provide disclosures on their governance of risk management, their strategy, the risk management processes, and the targets or matrices, how they are set and how they are measured. This IFRS S1 is implemented, and without the implementation of risk management framework by the organization, you are unable to provide the disclosures. When we talk about IFRS S1, it is specific to the climate related risk and opportunities. This provide you have to provide again governance of climate related risk and opportunities, how the strategies has been implemented, how the climate related risks have been identified, and how they are assessed, and how the mitigation strategies have been implemented against those uh, risk identified, and it set the scope 1, scope 2, and scope 3 missions as well. You have to provide the disclosures of scope 1, scope 2, and scope 3 missions as well. And how have you calculated this, and how the targets have been set, and how are you planning to mitigate those risks? So without implementation of risk management framework within the organizations, you are unable to provide these disclosure requirements, which are now mandatory to be provided in the annual report of the of the organizations, which have to be audited by the external auditor. So, what have you provided that has to be audited by the external auditor? Currently, we have seen that the risk management framework talks about all kinds of risk, whether it's environmental risk, climate risk, operational risk, financial, regulatory risk. But for the time being, the IFRS has made it mandatory for general disclosures related to sustainability and climate related risk. Later on, with the development within the IFRS and in the worldwide, all type of risk will be implemented and will be shown in the annual reports. Currently, it's as per if we talk about regulations set by the ICAP and ICMA, you have to provide the risk governance and internal control policy of your organization, how the framework has been implemented. These are the requirements within the ICAP and ICMAP to provide this framework within their annual report, along with the you have to place in the director's review. So we were discussing about the importance of risk management framework. We have discussed that IIA required that you have to implement three lines model. The second line of risk is risk management. Now we discussed about IFRS requirement, which is now mandatory. This requires to provide disclosures related to general disclosures and climate related. With respect to Pakistan, the SECP has made it mandatory. They have three phases, phase one, phase two, phase three, and the period beginning on or after 1st July 2025, the listed companies have to having turnover more than 5 billion in the last two consecutive financial years, or if they have number of employees greater than 1,000 or assets more than 12.5 billion, the IFRS S1 and S2 requirements are applicable, and the phase two is starting from July 1, 2026. These are the requirements. If the employees are 500 or more, and assets are 6.25 billion and turnover is 12.5 billion or above, they have to provide disclosures of IFRS S1, S2 in their annual report. And in the third phase, it will be applicable on all the organizations. This is basically
Also,
chartered
one
management
question,
account.
one participant is want to know the difference between the sustainability related and climate related risk.
Okay, the climate related risks are basically related to only climate, whether the climate is affecting the organization. Uh, for example, if there is a flood, they will affect the infrastructure of the organization. So you have to provide that due to flood, the operational activities of the organizations has been effective. And what kind of mitigation measures have been implemented by the organizations? And due to the operational activities of the organizations, what kind of and amount of emissions they are emitting to the in the environment, and that environment is affecting the climate, the people, and the surroundings. So this is specific to the climate-related risks uh, related to the operations of the company. If the company is involved into such kind of operations which is affecting the climate, then they have to provide the disclosures related to IFRS S1, sorry, S2, and the kind of risk related to their operations affecting climate and the mitigation measures adopted and how it will implement those mitigation measures to reduce that amount of emissions in the environment and the mitigations measures to uh, you say um, how that not affect the operations of the organizations. Because at the end of the day, the organizations, the investors, the shareholders have invested in the organization, and they want to know how the operations will run smoothly due to these extreme weather conditions, due to flood, due to high temperatures, and whether they have to invest in the company or not. When you talk about Europe, if you are exporting uh, uh, garments or any clothing to the European countries, they are now requirement they are that you have implemented climate related implemented measures in your organization. Otherwise, you are will be not able to export those your goods into the European countries. So this is the climate related risk. And IFRS S1 only talks about general disclosures, like you have to provide your governance structure, how you the board of directors, management have implemented their framework and their responsibilities within the organization, and how the risk appetite, risk tolerance, and risk culture has been implemented, and what are the strategies to cope up with the risk management process. Uh, and how the organization is prioritizing or identifying the risk and what are the measures. So when you can say S1 is a generalized uh, disclosure requirement which cope up uh, all level of risk, whether it is climate related, operational, or financial. And S1 is only related to the climate related risk.
Thank you.
Okay, ICMA has uh,
Uh,
the
There is some defer by the by the SECP in Pakistan for the adoption of the S1 and the S2, as mentioned by our participant Mohammad Yusuf Khan. Maybe
what is the question?
SECP has deferred the adoption of the IFRS as mentioned you in your previous slide regarding the adoption of the IFRS S1 and S2 in the 2025, 2026, and 2027.
Okay, I'm not aware of it. As per my knowledge, it has not been deferred yet. In fact, the bigger organizations are into the implementation phase, and in the upcoming financial statement, they will be providing disclosures related to S1 and S2. For all the organizations which are smaller one, it has been will be implemented from July 1, 2027. And for upgradation in the SECP matters, the SECP website may be consulted, or the corporate governance related to SECP uh, uh, may be seen. But as far as my knowledge, they have been are already in the implementation phase within the bigger organizations in Pakistan. Okay, this is the flagship journal of ICMA Pakistan Chartered Management Accountant Journal. And you guys have to see these articles which are published on a quarterly basis. And this November-December 2025 journal is specifically about ESG reporting within Pakistan. So to enhance the knowledge, you guys can refer to the ICMAP website and study these journals. Okay, we were discussing about the governance and objectives, importance of risk governance framework within the organization. So this is the Listed Companies Code of Corporate Governance Regulation 2019 within Pakistan, where they say that the board is responsible for the governance of risk and for determining the company's level of risk tolerance by establishing risk management policy. So we have already seen that the ISO 31000 discuss about the role of board of directors and the management. So again, the listed company regulations talks about the board responsibility regarding setting of risk tolerance levels and risk management policies, and the risk management committee of the board of directors will monitor and review all material controls within the organizations and ensure that the mitigation measures implemented are robust and that the financial statements provided in the annual report are of to give true and fair view and are within ensure their integrity. Also, uh, within the annual report are disclosures of risk management framework and internal control system, which I have already discussed, will be uh, uh, shown in the director's report of the annual report. Now we will talk about the state-owned enterprises audit committee, internal control and risk management regulations 2024, which have been implemented within the Pakistan. These are applicable only to the public sector organizations which are owned by the state. So these are the public organizations like PSO, Sri Northern, and likewise. And these set the tone and roles of audit committee, internal control and risk management committee, and the senior management, where they say that internal audit committee shall oversee risk management strategies, ensuring that as state-owned enterprise is prepared to discuss and address regulatory risk, political influence, and other challenges. This include reviewing risk management policies and internal control system. So you can see there is no such requirement about risk management committee now as per the State-Owned Enterprises Act. So internal audit committee may see the role of risk management function as well and shall ensure that the risk management framework and internal control system are effectively implemented within the organizations. And also, the organization has to implement a comprehensive risk management framework within the organization. So when we talk about risk management framework, there are two type of frameworks, which are COSO ERM and ISO 31000. And the state-owned enterprises regulations have also mentioned these two frameworks that may be implemented either COSO or ISO 31000. Okay. Now, as we have already seen the basic concepts and importance of risk management, uh, governance and management, and we see the regulations requirement, specifically mentioning COSO and ISO 31000. So now we will discuss about different management approaches and frameworks applicable and which may be adopted by the organizations.
Devasa, before that, I think we should now once again launch the poll so that we can engage the participants. There is a poll on the screen. Participants are requested to answer the poll. The correct answer is risk appetite is the amount of the risk on board level that an entity is willing to accept. It is not considering or not a judging. It's the willingness of the board level acceptance. Please proceed further, Jawasa.
Okay, thank you. Now we will be discussing about the different approaches and framework for risk management. So first of all, we have NIST SP 830. Uh, this standard has been developed by the US National Institute of Science and Technology, and it provides guidance for conducting risk assessment in federal operation systems and the organizations. Next, we have MOR, Management of Risk. It provides and enables the organization to support business change, optimize customer experience, and improve their processes on a continual basis. And there are various other different approaches and best practices. And most of the common which are nowadays are being used are COSO and ISO 31000. So COSO is a standard published by the Committee of Sponsoring Organizations. Basically, the top big four organizations, audit firms, sit together and they formed a committee, and they, as per the best practices, they set the guidelines regarding risk management, implementation, monitoring, and detection of prevention of fraud within the organization. So this COSO ERM framework provide guidance on governance and culture, strategy and setting of objectives, how the board shall exercise its risk oversight and establish their responsibilities, what shall be the desired culture, risk culture within the organizations, and how to set the risk appetites and strategies and formulate those strategies within the organizations, and how to perform the risk management process within the organization, and how to review and revise the risk management framework, and what will be the uh, reporting structure of the risk management framework. So this is an overview of COSO ERM framework. Now we will talk about why ISO 31000. Basically, ISO 31000 was started by Australia and New Zealand, and the standard was NZS 4360, and it was started in 1995. And at the later stage, it became so popular that in 1999 to 2004, it was become the standard to implement risk management within the organizations. And then in 2005, a working group known as Technical Management Board decided to establish a dedicated risk management standard which will provide guidance and principles and how to implement the process and activities within the organizations. Then they developed ISO 31000, and it was published in 2013. And later on in 2018, the second edition was published, and it focused on leadership and management and governance of the organizations. So it all started back in 1995. The ISO 31000 is a detailed uh, implementation of framework. Basically, the standard itself is 25 to 30 pages, but when you go for the certification and you will study the notes and how to implement the framework and ISO 31000, then the standards and related guidelines are more than 400 to 500 pages. So each and every line has a detailed version how to implement that in the organization. Whereas the COSO is not that in detail, it generally provide the guidelines. Whereas in contrast, ISO 31000 is a globally adopted standard. It can be applied to any organization, whether in the financial sector or oil and gas sector or banking sector, any sector, it can be applied as per the customer as per the needs and customization as per the processes of the organizations. So this is the overview of risk management standard, and it is based on some principles, framework, processes. We will discuss uh, and give us. I will give you an overview of these principles, process, and framework because in this limited time of 2 hours, it is not possible to uh, tell each and every dynamics and flaws that how to implement that principles, framework, and processes in the organizations. We will have an overview of this whole ISO 31000, and we will discuss some templates and practical scenario how to implement that in the organizations. So when we talk about the principles, basically uh, the principles are, you can see, it start with the integration, structured and it must be structured and comprehensive, customized, inclusive, dynamic, and best available information, human and cultural factors should be considered, and there will be a continual improvement in applying those principles. Uh, the relationship between there is a relationship between the risk management principles, framework, and processes. The principles are the basis of an effective and the efficient management of risk and management of the effects of the uncertainty on the organization's objective. They must be taken into account when creating the framework and applying the risk management process. So, when applying the framework and processes, these principles have to be taken into consideration. And then there is a framework which supports organization by providing the basic, like policy, objectives, mandate, commitment to manage risk, and the organization's arrangement, like what are the plans, relationships, accountability, what are the resources, processes, and activities for integration, designing, and implementing, evaluating, and how to improve that risk management. And then there is a process. The process is a systematic application of principles. So these principles are the foundation of this process and process. If we talk about the first principle, like integrated, uh, risk management is an integral part of the organizational activities. We have already seen and have a question on that who is involved in the enterprise risk management. So all the stakeholders, whether these are uh, employees, directors, uh, even suppliers, you have to tell the suppliers as well that we have implemented the risk culture in the organization. And if you are not involved in compliance to the regulations, like you can say PPRA regulations in the Pakistan, so you will be blacklisted. So all the stakeholders have to be involved, and the risk management activities and framework has to be integrated at all levels of activities within the organization. So the question arises, how to apply these integration. It can be applied through development of risk management framework. How to develop the risk management framework, we will see. And we will apply this approach of integration with the risk management framework while making decisions and our related activities. So next is the structured and comprehensive approach to risk management. It contributes to consistent and comparable results. And how we can apply in the organization, it can be applied through practices that consider the risk associated with the organization's context, the use of criteria, whether the criteria and scope is as per the line with of the organization's objectives and as per the scope of the organization's activities. So the approach must be structured and comprehensive. And as I've already discussed, that the ISO 31000 uh, provide benefit that it can be customized as per the requirement and internal and external context of the organizations. And the framework and processes may be customized to meet the needs of the organization. Uh, Inclusive again, it's a timely involvement of stakeholders to enable their knowledge, views, and perception to be considered. So when you have making a risk management and internal control policy, you have to include all the stakeholders like internal audit department, risk owner department, management, and the board of directors in preparation of this risk management framework. Dynamic again, you have to be dynamic, and the principles, frameworks, and processes may be changed as per the requirements of the organization or as per the emerging risk. Or let's say there is an implementation of IFRS S1, S2, so ha you have to accommodate the climate-related risk in those framework as well. So the framework should be dynamic and may be changed as per the requirements of the organizations or the regulations. And the another principle is best available information. So how to apply? It is important to obtain the best available information to understand the risk. So the organization has to invest in the research and development and use variety of methods, for example, collecting data from the peer organizations and investing in their employees through trainings and research and development activities. So when implementing the risk management framework, the risk management framework and processes has to be designed considering the culture and human factors and what are their needs and what are the scope and what are the requirements of the surrounding people, the environment, the employees. So you have to consider this aspect as well. So again, there is a continual improvement. Again, just like a dynamic, you have to learn to experience and continually improve your risk management framework. So we discussed about the principles, and now we are discussing about the risk management framework. So you can see the framework starts with the leadership and commitment. Uh, Leadership, when we talk about the leadership consists of senior management, the board of directors, you can say oversight bodies, which are their committees, the board, the managing director, and the senior most management of the organization. So the implementation of frameworks start with the leadership and commitment. So if they are committed and accountable, so they have some responsibilities. The regulatory bodies like SECP and the Code of Corporate Governance has already set the tone. What the board is accountable, what are the rules of the board. So if the regulations have not been implemented on on your organization, then ISO 31000 give a comprehensive accountability framework for the top management, whether it is board of directors or the management. So what they have to do, they have to ensure that risks are adequately considered when setting the organization's objective. And they have to understand the what kind of objectives the organization has and what kind of risk the organization is facing in pursuit of its objectives. And the top management have to ensure that system to manage such risks are implemented and operating effectively, and they have to ensure that such risks are appropriate in the context of organization's objective. And they have to ensure that information about such risks and their management is properly communicated within the organization. So they have to customize and implement all components of framework and ensure that you can see in most of the organizations they prepare the risk management framework and implement the framework, but they do not provide necessary resources and budget to the risk management department or associated departments because they consider that these are not operational departments and they consider them uh, that they are not making money for them. So the ISO 31000 emphasize that the top management have to ensure that the necessary resources and budget have to be allocated on the risk management activities. So once you have applied the framework, whether it's COSO or ISO, you have to apply all the clauses of that standard as well. If we talk about ISO, it's provide a comprehensive framework. So once you have adopted and given in your financial annual report that you have implemented the risk management framework as per ISO 31000, then all the clauses of ISO 31000 has to be implemented, and the auditors have to check whether you are applying those clauses or not. So the leadership has to ensure that budget has been allocated for the risk management function, and the necessary resources have been provided to them, and they have been assigned with authority, responsibility, and accountability at the appropriate level as well. And it is also the responsibility of the top management to implement a risk culture within the organizations. So they have to promote the risk culture, and that can be conducted through their trainings of the employees by making risk champions or risk focal persons within the organizations, and they have to be trained on the risk management activities and functions, how to identify the risk and how the culture of risk have to be implemented within the organizations and to ensure that the risk management framework remains appropriate within the context of the organization. So the leadership and management have a major role in implementation of framework and the processes as well. So again, integration, we have already discussed how it can be integrated. And if we discuss about the design, uh, you can see that uh, designing of a framework, uh, you have to consider the external and internal context of the organizations. What are the vision, mission, and values of the organization? And what is the governance structure and roles and responsibilities? And how the data will be gathered and the resources and knowledge of the organization and what are the external contexts like social, cultural, political factors, legal factors, what are the key drivers which can implement or drive the objectives of the organization. You can see in many public organizations, the objectives are very political driven. So you have, when making, implementing the risk management framework, you have to consider these factors as well while setting the objectives of your organizations. Because without the setting of the context, you will be not able to achieve your objectives and implement the framework in its true letter and spirit. So again, uh, you have to improve the risk management framework, integrate and design as per the requirement of ISO 31000, and evaluate the performance of all the stakeholders, whether they're senior management, internal audit department, or risk management department, whoever a person or a department is involved in implementation of risk management framework and implementation of its effectiveness. So all the key stakeholders have been evaluated on the basis of that framework. Uh, this is a clause 5.2 of ISO 31000, which talks about role of top management and oversight bodies, which we have already discussed, that they have to set the tone, implement strategies, allocate resources, and ensure effectiveness within the organization. Before starting risk management process,
I think we should also engage the
yeah,
participants and relaunch a new poll.
I have launched the questions.
All the remaining participants are requested to please answer their poll so that we can save time and move further. The primary reason of the failure of risk management could be the lack of support from the top management. But although all the factors are relevant in the successful management of risk, before moving further, thanks to Mr. Yusuf who have shared us the updated SCCP guideline for the adoption of ESG disclosure. This ESG disclosure has been deferred till 29. Phase 1 will be started as July 1st, 2029. Phase 2 deferred till 2030 and the phase 3 is deferred till 2031. Javasab, you can continue your presentation. Thank you. Javasab, please share your screen.
Screen visible?
Yes, your screen is visible. Please play the slide mode.
Okay. Okay, now we'll talk about the risk management process. So basically, the risk management process involves of all the risk management activities like risk identification, risk analysis, evaluation, treatment. Before setting the risk management process, the organization has to set the scope, context, and criteria, which we have talked about. The external or internal factors have to be considered before designing of objectives and implementation of the framework. So this is the scope, context, and criteria. Due to limitation of time, we will go to the scenario, an example, and we'll try to understand from that example. We will try to understand the risk management process through this example. Okay, ABC Manufacturing Limited is a medium-sized manufacturing company with annual sales of approximately $50 million. It supplies industrial equipment to around 200 corporate customers on 30 to 60-day credit terms. And to increase the market share and achieve ambitious sales target, the company adopts a more flexible credit policy by offering higher credit limits and extended payment terms to key customers. One of its largest customers, XYZ Traders, contribute 20% of annual sales and is granted a $2 million credit limit due to its strong payment history. Over the next 6 months, XYZ Traders begins experiencing financial difficulties caused by the economic slowdown. Payments that were previously made within 60 days start exceeding 90 to 120 days. Although the finance department identifies the increasing overdue balances, the sales department continues supplying goods to maintain revenue and customer relationships. As a result, XYZ Traders' outstanding balance grows to $2.5 million, exceeding its approved credit limit. Shortly afterwards, XYZ Traders became insolvent. Despite recovery efforts, ABC Manufacturing recovers only 2 million, while the remaining 500 million is the zero point 0.5 million is written off and there was a bad debt. The loss reduces profitability, creates cash flow pressures, and increases borrowing costs. ABC management concludes that the loss was not solely due to customer default but also resulted from weakness in credit risk management, including excessive reliance on one customer, inadequate monitoring of customer financial health, failure to enforce credit limits, continued sales despite overdue balances, and poor coordination between sales and finance department. The company therefore decides to strengthen its risk management framework by defining its risk appetite, risk tolerance, risk capacity, and all that processes. So management recognizes that extending credit is essential for the business growth. So you can see there the risk cannot be zero. So you have to set some risk appetite levels. So management decided that credit is essential for business growth. Therefore, the objective is not to eliminate credit risk, but to manage it within acceptable limits while supporting profitable sales growth. Okay, now uh, the process start with the setting of scope and criteria. So we have to first, when we will be implementing the risk management framework and processes within the organization, the risk appetite, tolerance, and capacity shall be decided by the management and the board, shall be approved by the board. So the scope and criteria and appetite levels have been set, and they decided that the day sales outstanding is up to 60 days, and bad debt ratio shall not exceed 1%, and no individual customer should account for more than 15% of total receivables. And the tolerance level is DSO up to 70 days, and for risk capacity, it will be exceeding 75 days, and receivable over 90 days, and bad debts ratio up to 1.5%. And for the risk capacity, they have said that they have a capacity to absorb bad debt losses of up to 2 million in a financial year. So there will be in the example, there was a 2.5 million bad debts loss, and 2 millions were recovered. And in this scenario, they have set the capacity of up to 2 million. So you basically at the start of implementation of risk management process, you have to set the scope and criteria and appetite levels. Next phase is risk identification. Risk identification is the process where we identify a number of risks. And if we talk about theory, there is various approaches and like you can say brainstorming sessions, interviews, and you read about the manual and process and identify risks. You go to the risk owner department and discuss them. What are the events or causes that affected your objectives and processes in the past, and you make a risk universe from that. So in that scenario, you identify future risk. So that as per our theoretical example. So as when you try to implement it in the process, so this is the risk identification phase where you divide the risk into three phases, which is event, cause, and impact. We have already at the start of our presentation, we understood what is the event, what is the cause, and what is the impact. So you have to write your risk statement, which should involve these three factors, which are event, cause, and impact. Like the event is there may be a risk. So one thing should keep in mind that already an incident has been occurred, and you are now planning on that event about the future emerging risk. That may be a risk of future events where various other customers may default. So now you are preparing for the future scenarios. So the event is the customer failed to pay their outstanding receivable on time. This is an event. A cause, there may be multiple causes within the organization or outside organization. Uh, you have to mitigate each and every cause. So first you have to identify the causes. There may be multiple causes: weak customer credit system, economic downturn, which are affecting the customers, and the excessive dependence on a single customer, inadequate monitoring of customer financial health. Finance department is not performing its activities effectively, or there is a failure to enforce approved credit limits by the internal audit department or the finance department, and there is a continued sale despite overdue balance. You can see there are lack of coordination between the departments. That may be the cause. Internal audit department may have identified that risk or control weakness, but there, due to lack of coordination, the risk arises. Or so you can see for a single event there may be a multiple causes and multiple uh, uh, consequences. Like there may be a bad debt losses, reduced profitability, liquidity issues, and or possible breach of the loan covenants. Once you have identified the risk, the next phase is risk analysis. In risk analysis, we use the criteria which already approved and set by the top management. You multiply likelihood and impact, and there is a risk level. We have already seen uh, in this example, we can say that the likelihood is for the customer can face financial difficulties in the future as well, and particularly during economic downturns. So there is a likelihood that it will affect the organization again. And if that is uh, affected the organization, the impact would be severe. For example, there will be a large financial loss significantly, which affect profitability and cash flow of the organization. One thing has to be kept in mind that all these judgments are as per the organization and its own criteria, which is set by the organization or the department. So once the criteria has been set by the organization and approved by the board or senior management, you have to stick with that criteria. You cannot say that, let's suppose you can say in the past 5 years, there is a likelihood of only one event. In the past 5 years, only one customer has defaulted. So on the basis of last 5 years, you say that if only five customer default, we can say that it is two, likelihood is two. And if it is more than 10, then it will be five. So once you have set the criteria, you have to stick with that. So on the basis of past event, you will get the likelihood, and on the basis of the financial losses or whatever the justification or criteria you have set, you will set the criteria for the impact or losses. So once it has been set, you have to multiply the effect and see what is the risk level. So in that case, the risk is extreme risk, and that is an inherent risk. You have to identify in your risk register that what is the risk level before there is controls, and after the controls, what is the residual risk and what is the risk level. So maybe the organizations had adopted controls, or already the controls are implemented, like there is a approved credit limit, and their monthly receivables of and aging reports have been reviewed by the management, and their management approval is required for the large credit facilities. So the controls are already there. So we can say after the existing controls, there is a residual risk. So in that case, you have to identify the control gap. If there is a risk despite the implementation of controls, what is that gap? So you have to discuss with the stakeholders, and you have to see the internal audit reports. You have to discuss with the risk owner departments, and you can identify the what are the controls. So maybe there is a control that management approval for large credit facilities is required, but in practical scenario, there is no no approval from the management, and the staff under the management have been doing itself. So you have to identify the gap and mitigate those gaps identified by the risk management function. So next step is risk evaluation. Once you have assessed, you have to prioritize the risk and evaluate the type of risk the organization is facing. Maybe you have limited budget and limited time, so you have to see what kind of risk are high level, extreme level, and you have to prioritize those risks and mitigate those strategies as per the prioritization and evaluation of that risk. So next is risk treatment. Once you have identified and evaluated the risk, you have to treat the risk on the basis of their likelihood or impact. You can treat either likelihood or control the likelihood or the impact as well, or both of them. So the mitigation measures may be to reduce the likelihood, impact, or both of them. You can work either way. You cannot say that I will, by implementing that control, I will only control the likelihood. There might be some risk whose impact can be controlled. There might be some risk whose likelihood can be controlled. So you have to see what kind of controls measures have to be adopted to mitigate those risks. These are the type of risk treatments which are avoid the risk, reduce the risk, transfer risk, accept, and pursue. ISO 31000 and its related material has a lot of information on these risks. So avoid is basically you decide that you have to avoid this risk by not pursuing your objective. So the best treatment is to avoid this risk by not pursuing the objective of the organization. And reduce the risk is to mitigate the risk by reducing its likelihood or occurrence or impact. And transfer the risk is like you transfer the risk to some other department like insurance companies. Accept or retain that you have to retain the risk and accept the risk as per your willingness or appetite level, and then pursue your objective. And pursue the risk you have to pursue in either way. You have to pursue the your objective, whether you are accompanied by various risks, but the object you have so much clarity that you have to achieve those objectives. So you can pursue the risk and go for your objectives. These are the phases: risk identification, risk assessment, prioritization, and treatment. And the treatment involves the mitigation strategies. In this scenario, we have seen an example. So now we'll try to implement the mitigation strategies, like we will conduct comprehensive customer credit assessment. You have to keep in mind that the mitigation strategies are adopted after identifying the control gaps. If there is no such controls existing in the company or processes, then the mitigation or controls have to be designed from the initial level. But if they are already designed, then you have to identify the gap and implement the mitigation measures to control that risk. Next phase is risk monitoring. We have already at the start of implementation of risk management process designed the risk appetites and tolerance level. Now we will measure it with key risk indicators which will be approved by the management or board of directors when implementing the risk management process. So the management or the function have to uh, evaluate and identify the risk levels with those KRIs. These KRIs are the red flags for the organization or the department. So the risk appetite for this example is 60 or less than 60 days. So when the credit limit or days outstanding are reaching to 60s, you have to be vigilant. and after 60, the red flags arises. So these key risk indicators give a bird eye view of how you have to monitor those risks in your organization. These are the very important uh, uh, thing for the implementation of risk management framework, and you have to approve it from your management and board of directors, because ultimately the responsibility of implementation of framework and key risk indicators and implementation of all the strategies is of oversight bodies. And after risk monitoring, you have to provide reports to the management or risk committees or the board of directors, and you have to uh, design whether it will be on a monthly basis, quarterly basis, as per the requirement. So we have already discussed the opportunities as well. In this scenario, there is a if it is identified that uh, there were some controls measures which were not adopted, and after implementation of that controls, there is an opportunity that they have implemented the automated receivable monitoring system, and they have purchased credit insurance policy, and they have diversified the customer portfolio to reduce dependence on a single customer, and improve business resilience. So you can see in a single risk, when we started to implement mitigation strategies, and opportunities arises, and that has been implemented, and that shall be beneficial for the company in the future as well. So at the end, there is a risk reporting, which is a process and a documented mechanism. Either it's maybe an automated system which provide an overview to the management and the board of directors for informed decisions, and improve risk management activities, and interact within the different stakeholders. Uh, uh, we have a term risk register as defined by the ISO. Uh, Basically, the risk register brings together all the information of risk identification, assessment, likelihood, and mitigation strategies on a single page, on a single automated system, to give the organization and management a decision-making approach. This is the template of risk register, which has been designed and shared by the ISO. You can see here we have a risk ID. It can be on an Excel sheet or an automated system as well. So basically, the template has been provided. This is the least requirement. The organization can customize as per their needs. So there is a risk ID, risk category may be financial, operational, compliance, regulatory, whatever it is. There are 21 categories, and company has to decide while designing their framework what type of categories they will be going. And there is a risk description. We have seen how to write the risk description, which involves event, cause, and consequences. Then, what are the existing controls? You have to provide an overview to the management. What is the existing control? What is the likelihood and impact? And what is the risk score after the implementation of that controls? And you have to mention who is the risk owner, what is the risk strategy which have to be adopted, and what action plans you are going to implement, and what is the risk scoring after that implementation of those action plans and mitigation measures, and what is the risk appetite status. You have to you may mention it in a qualitative form or a quantitative as well, and what are the KRIs from which you have to measure the gap, and what is the review frequency, and what is the current status. So this is the template of a risk register. You can take screenshot as well. We have already seen monitoring and review system within the risk management process. So this is our requirements of standard, which make it the purpose of monitoring and review is to assure and improve the quality and effectiveness of process design, implementation, and outcome. The standard emphasize on monitoring and review as well because it provides the accountability to the management, to the risk management function, and it established the baseline uh, of what is the mandate of the board, what is the mandate of the management, and it can also help in reviewing the risk management framework and risk management process. You can see the ISO is very detailed, and on each and every clause, it has provided uh, uh, the framework of implementation and how it is applicable and how you can apply that within your organization. So this is the overview of monitoring and review process. So that was the overview of our risk management ISO 31000 and orientation session, where we try to understand and about the what are the principles and frameworks and processes of ISO 31000. What is the role of oversight bodies, the board of directors, its committees, internal audit committee, risk management committee, and sustainability committee, and the senior management. The ISO 31000 provides a detailed uh, criteria and process and responsibilities of the oversight bodies and management, how to apply risk criteria, determine risk appetite and tolerance levels, and how to identify, assess, prioritize the risk, and how to implement those risk mitigation measures. And this is an orientation session of ISO 31000. And you have, if any one of you is thinking to get the ISO 31000 certification, you have to be at least have 2 years of experience in risk management function to appear in the ISO 31000 certification. Once you are ISO 31000 certified, you are able to implement the risk management framework within the organization. We have how much time left? 5 minutes? Perhaps not.
Yes, we have 5 minutes, but we can take the question in the meanwhile.
Yeah.
So, what will be the cost of taking ISO certification in Pakistan?
Sorry, please come again.
How much will be the cost and duration of taking the ISO 31000 examination in Pakistan?
Okay, basically, first of all, you have to be an experience of 2 years in risk management function or related, like internal audit department. Then it is done through PECB Canada, which is the certified body of ISO, which provide training and conduct examinations. So all the cost, including the training and the paper, is cost around $1,000. The exam is, I think it's $500, and the training is you can uh, take training from PECB directly or any other organization as well, but you have to give the exam, which is around $500.
Okay, next question is for the candidates in the internal audit profession, which certification is more feasible for them? ISO 31000 or any certification from IIA, just like IIA is providing the CRMA certificate in risk management assurance.
So basically, the person working in internal audit department, their main focus is to see the effectiveness and implementation of risk management framework and processes within the organization. So they have to focus on their core internal audit qualification, like IIA, the CIA as well provide core internal audit uh, certification, and CRMA is all is already focused on effectiveness and implementation of risk management framework. So a person working in risk in the internal audit department has to focus on internal audit certifications. As far as ISO 31000 certification is concerned, it is specific to the persons working in the risk management department because provides a detailed knowledge of how to implement risk management function processes and principles within the organization. So it's at the baseline. For person working in risk management departments, it's an operational requirement that he has a knowledge of implementation of processes and framework, and has an overview and provide trainings and risk cultures within the organization. So once the baseline has been set, uh, the third line of defense is internal audit. It just like internal audit provide assurance to other department, it has to provide assurance to risk management function as well that its processes and frameworks are implemented effectively. So they have to check whether the ISO 31000 has been implemented, and if implemented, whether that the department is complying with the standard or not.
That's cool. Uh, Thank you very much, Mr. Jawad, for your wonderful presentation and time. And also, I am thankful for the participants who have spared their time for the learning. And we are also expecting the same engagement from the participant in the future as well. Mr. Jawad, once again, thank you very much. And can you please share your LinkedIn or any other contact option with the participants so that they can reach you and get guidance on the risk management and the other topics as well?
Okay, should I share here or
You can share here.
okay, let me share a link.
One more question about the examination center in Pakistan of
Okay,
ISO 30
it's
or 31000.
basically it's online. The PCB Canada take the exam online, and you have to be alone in the room, and there will be two cameras, one pointed to yourself and one taking the 360-degree overview. So it can be taken online. Uh,
Thanks. Many participants are asking about the recording. This webinar is live at the YouTube, LinkedIn, and the Facebook. You can take the recording from these social media websites.
okay, I'm unable to write here the link of my LinkedIn.
Uh, Participants can search in the LinkedIn by the name Jawad Ahmed.
Yeah, they can search on the LinkedIn as well as on the post shared by the ICMA. They have tagged me as well. They can go there and reach me anywhere, anytime. And thank you, Shoaib Saab, and the participants. And I hope today's orientation has given you a useful foundation for understanding ISO 31000, and more importantly, encouraged you to think about how these concepts can be applied in your own organization. I would like to sincerely thank all of you for joining today, particularly those who have taken the time to participate from different parts of the world, and a special thank you to everyone who contributed through the chat and question and answer. and our member of ICMA who have shared the updated SECP regulations. And I hope this is not the end of our discussion on risk management, but the beginning of many more conversations and practical applications. Thank you, Shoaib Saab. Thank you, participants and ICMA.
Thank you to all of you, and especially Jawad sir. Thank you very much.
Okay, thank you.